syndication and multifamily. We're talking about the big deals today. That's what you're into on the Sub2Deals Show. Hey, D grabbers, welcome to this episode of the Sub2Deals Show, where we talk about all things subject to. Now, occasionally we'll talk about other real estate investing topics, but it's always something to help you with your real estate investing business. If you're listening to our podcast today on Apple or Stitcher or any of those other podcast platforms, we'd like to invite you to go check us out at our YouTube channel. You can do that at sub2tv.com. You can watch our podcast, see our smiling faces, and watch all of the other videos that we release each and every week, just about one every day. Podcast, Facebook Lives, YouTube Lives, and there's all kind of training on creative finance and Sub2. So it doesn't cost you a penny. Get over there, check it out. If you're interested in learning more about creative finance and Sub2, I'd like to invite you to check out our $7 coaching. You can go to $7coaching.com. It is the price of a latte every month, $7. I'll answer your questions personally, and we'll teach you a lot about Sub2 and creative finance. If you can find a better deal on teaching creative finance, let me know, because I want to get in on some of that. Guys, today we're not talking about Sub2. We're talking about syndication, multifamily deals, and some of that stuff that some of us are just, I guess, a little bit afraid to get into. Some of the really big deals, just more zeros, they say. But we've got an expert on today. Charles Carillo is actually a managing partner of Harborside Partners, a real estate syndication firm. And he's been doing multifamily and commercial real estate since 2006. He's invested in over $200 million worth of real estate. And he's also the host of Global Investors Podcast, where he interviews professionals about investing in U.S. real estate. So we'd like to welcome Charles to the Sub2Deals Show.
Thanks so much for having me on, William.
Hey, glad to have you here. You know, I know you and I were talking before we came on, and I said, I'm a single family guy. I've been one my whole investing career, 24 years. And people start talking about syndication and that sort of thing. And it sounds really scary to me, but hopefully you're going to demystify some of that stuff for us today. But first, tell us about you and about how syndication works and why you're the expert in this field.
So I've been involved with multifamily investing since 2006. I bought my first property. It was a 3-family property. And a house, what we call house hack it now, which is where you live in one unit and rent out the other 2, and it takes a big chunk out of your mortgage payment. But back then, it was just didn't have fancy house hacking terms and stuff like that. There was no bigger pockets, so it was kind of just flying by the seat of my pants. And I kind of had a mentor for my father as my father. He had been investing in multifamily since 1984. Started with a 6-family property. And he grew that with a partner to almost 100 units, and they owned them, no syndication, and they self-managed them as well. So it was quite the learning experience. The one thing, though, is that a lot of D-class properties. So it wasn't something I wanted to do when I started. And when I started investing in multifamily, my dad was pretty adamant about buying better properties in better areas. And I really started with like C+ type properties. And so I self-managed. I had a handful of those properties, so smaller 3 families. I had a 5-unit mixed use, so you have like retail. It was an office on the first floor, then apartments above it. I bought that, renovated that whole thing, and then I self-managed it from 2006 to 2012. I moved to Florida in 2012, and then really for the last several years, we've been focusing on syndication, larger multifamily. And, you know, I know the show is mainly put around single family, so we can definitely talk about the transition of, or just starting with renting out apartments and kind of some of the nuances between single and multifamily. But I learned about syndication initially in 2008, and I wanted nothing to do with it. Like you were saying, William, I never want to ask anybody for money. I did not like that. I had debt investors, but I never had equity investors
Mhm.
until a few years ago. So it's a whole different experience when you're raising money for anything. Real estate making it a little easier since it's a little bit more secure compared to other things you can raise money for,
Mhm.
businesses and like angel investments and startups and all that stuff. But
Right.
it is there's a lot of moving parts when you're getting into syndications,
Right.
much different than when I used to do it. And you're just it's your money. I'm buying
Mhm.
property. I'm the only person that's making these decisions, and I know exactly what has to happen, and I'm not really relying on anyone per se.
Right.
Um, when you get into larger syndications, one of the things I found is that partnership and teamwork is really, really important when you're
Right.
getting any of these larger properties, because everybody's got their area of specialization
Mhm.
where they're going to focus. And, other people on your team need to focus on certain things because there's a lot of moving parts when you're getting into large deals, especially when you're bringing in investors and raising money from them. And, you have this tight time window between just like you're closing on any property. You got, 30, 45 days, something like this. And in 30 days, you've got to get all this money, it's got to get into a bank account. You
Right.
got to do the due diligence. You've got to look at, 100 different units. You've got to review leases. It's a much more when you're taking on investor money. It's a much more of a in-depth process
Mhm.
versus when I used to buy just multifamilies by myself. And we get a one-page lease at closing for each
Right.
unit, and some of them didn't have anything, and it's a much more sophisticated look when we're getting into syndications
Mhm.
where we're actually reviewing the leases and due diligence, and we're grading the leases and knowing how good the tenants are or how bad they are, or what we feel the likelihood is they're not going to perform like within say 30 to 90 to 180 days after purchasing a
Right.
property, because this goes into our whole renovation kind of schedule of what we're doing to really renovate the property and ultimately reposition it over 5 years.
Right. Right. I have a friend actually. It's coincidental. He just went to a training in Texas this past weekend, and we were talking last night about this very thing. And I love having guys like you on here because even though I don't do it, I know a lot of my students actually transition.
Mhm.
A lot of people get started in single family and then they want to do multifamily. They want to do apartments and create, that big passive type income. But I just never made that transition. But I know a lot of people do. And we were talking about it, and he was telling me that you have to have a credit person. A lot of times you have to have a money person and just the several people involved. And I said, well, gee, that sounds really complicated. If I get a seller call today that says, hey, I heard your ad, will you come by my house? I can go meet with them. They can sign a contract. I can have title run and I can close on that house in 2 or 3 days. It's really a simplified process.
Yeah.
But when you're saying when you have to have a bunch of people in agreement, that seems complex. But so lay it out for us really simple there, Charles. What is real estate syndication?
Yeah, so real estate syndication is just a fancy term of just group investing,
Mhm.
and it became really popular in, I believe it was 2010, when Obama put through the Jobs Act, which allows us to before what this was for many decades prior, until like really the 30s. This is really like country club investing,
Mhm.
where I'm buying an apartment building. We're having lunch together at the country club, and I'm going to get 10,000 from you, 10,000 from this, 10,000 from that doctor over there down the way, and we're going to buy this property. And now it's a whole different ballgame because up to this point, it was really like REITs, where like the way of people passively investing into real estate, the only way was through like a real estate investment trust that you can
Mhm.
buy through any kind of brokerage account. And with syndication group investing, what we do is there's two parts to how the process works. There's going to be general partners, the operators, also known as sponsors or the syndicators, and that's where our firm is. And then on the other side of it, you have the passive investor, where the operators are also passive investors. They are already put money into the deal, or they should be. If you're investing into a deal, they should, but we do. So we are on the other side too. And that's we usually bring about 20% of what's required to close on the deal and for doing the work, whatever 20% of is required for the deal, we would put in ourselves. That's kind of general for our general partnership. And what happens is the passive investors, after they invest in the deal, so they do their due diligence on the deal, on the sponsor, the general partnership part of it.
Mhm.
The passive investors, also known as the limited partners, are pretty much done. They don't have to do any other work, and they are completely passive from this point on.
Mhm.
Most deals that we do will have a monthly or a quarterly distribution that will usually start. somewhere between 3 to 6 months down the road. So depending on what the quality or what the place of the property is that we're purchasing. If it's a much better property that is much, there's a better tenant base, there's minimal work that has to be done to get it up and running or where we are, that's going to be a quicker, those distributions will start. If it's something what we call a little bit more of a heavy lift, we might say that might take 2 quarters for that money to start. And what happens is typically that distribution is usually 7 to 8% per year. So on a quarterly basis, it would probably be like 1.75% of what you invested, just to make it easy numbers for everybody. And then what we have is we will hold that property. It's typically for, usually we'll say in paperwork, 5 to 7 years. Over the last few years, those have been much shorter. And the last 3 or 4 deals we've done, they've gone just around 3 years. And that's probably not something that's going to continue, but it's just how it was. We were getting where we were our returns, and we were getting the property to where it had to be in a shorter time frame. And so when we're doing this repositioning of the property, what we're doing really is we're making it more efficient. We're taking out old management. We never keep the management in there. So there's going to be, in these larger apartment complexes, there's on-site management. And there's also going to be, they work for a property management company. So we're going to change out the property management company. That's usually changing out the on-site management as well. Right. And when we talk about on-site management, just rule of thumb, for every 100 units you have, they'll have an office there. There's usually one admin person and one handyman. Okay. And that's for taking care of a lot of your small repairs around it. Obviously, we'll call in licensed contractors when there's an issue that requires that. But most of the issues are really just handyman problems. So that's kind of a rule of thumb of how many people you have. You have probably 4 people to 5 people if you have 200 units. And we're going to change out everybody on site. And we're going to put in our management that we'll have in that area. And at that point, what we're going to do is we're going to do what we're going to work through the business plan. So before we buy it, we have a business plan of what we're going to do. It's typically somewhere, say we're buying a property and the rents are $1,000 a month. Okay. And a property across the street, let's just say, has had some renovations. They have some upgrades. They've got some nicer appliances and some newer counters and cabinets. And they're getting, say, $1,300. So we might say, all right, we're going to do the same renovation there. And we're going to put our numbers, say, at $1,225 is what we think we can get. That way, it's very conservative, but it allows us now over that 2, 3 year, 4 year period, we are going to renovate every unit in the interior and re-rent it at a higher rent. Hopefully, we're going to get what they're getting across the street. But our goal is just to get what our pro forma is, what our estimate is in the business plan. Now, the interior renovations, but there's also a lot of exterior renovations as well that go with it. Sometimes you'll need to have new roofs. There's landscaping is usually an issue. There's a number of different problems with the property, and some of them are problems. Landscape is not really an issue per se, but it's something that leads to getting people in the door to rent and keeping people there afterwards. So we're kind of working through and taking care of all these different pieces that are going to add income to the property. And then usually when we're switching management, we're also switching vendors. So if we had vendors for trash, we have vendors for the HVAC systems. We're usually going to change this and go with one that we've worked with before. And typically we're going to get a better price on that as well. And it's really going through and making the property more efficient. And that's where we can get these returns. And typically, because that's usually the next question, what we like to see, there's no guarantees of returns, but typically when we're looking at a deal, we want to see investors having over the lifetime of the investment a return of mid to high teens in returns, 15, 17%, something like this. It makes sense for us to do the deal because we're sharing in on those profits, and it makes sense for the investors to take that risk.
Gotcha. Okay, so let's just say that you're doing a deal and you've met me and I have some money to put into something. You would approach me about investing in a deal. Is that how it works?
Right. Well, usually, yes. What we'll do is we'll talk to investors, and then what we'll do is I'll have a call with them if I don't know them already. They'll have a call with us or one of our partners, myself or one of the partners, and we'll add them into our email system. And then what happens in that scenario when we do have a deal? So when we have a deal that comes through, we've reviewed it, we've signed off on it. We have a third-party underwriter that we pay specifically that looks at the deal as well and underwrites it. And these are deals that are brought to us from another partner. So there's really like 3 sets of eyes that are looking at it before we confirm we're going to move forward with it. We send an email out to the investor base. In that email tells you about the deal. You can download our 25 page investment offering PDF. You can also submit a little what we call a soft commitment, which means you put in your information, how much you think you want to invest, and then you'll just put there'll be another box there that says on a scale of 1 to 10, 10 being I'm wiring money over today, or 1, I don't want to invest, but I want to talk to someone about this deal. We can then know exactly how much money that we have coming in. And once we have reached the amount of money that we need to close on the deal, we put people on what's called a wait list. So it's all done by email, and we'll build those relationships throughout. I mean, that's mainly what we're doing when we're raising money, is building relationships and letting people know exactly what we do.
Right. So how does let's just say that I'm on your list and I say, okay, I want to get in on this deal. Is there any due diligence that I, as an investor, should be doing, or do I just trust you because you look like a nice guy? How does that work?
So you should be doing your due diligence on the operator prior to getting a deal. And when we have a call, so we'll have people that sign up on our website for our investor club, and some of them will get on a call with one of us, some of them won't. And when you get on a call with one of us, what we do is we will, after the call, I send you out a whole Dropbox folder of a ton of information. And that information is everything about, we have books on syndication that we've written, that our attorneys written. We have a lot of before and after pictures of deals we've done, sample investment offerings, which is really important. So you know exactly what's going to come to you. So you know what to look out for, so you can review and be comfortable. And that way, when you do get the real investment offering from a deal that you might be interested in investing in, you can review it and you can see all the different parts, and you understand how the flow of it works, and you know kind of what's important for you, what's important to you, what you think, and you can review it. And then from the time that the deal hits your email box to the time that funds are required, we usually like to be at least 3 weeks. So that gives people enough time. They can put in a soft commitment, and they can also review the deal and speak to anybody they have to. It's not like an overnight thing. So it's not something where, hey, you just said today and you got to wire your money tomorrow. It's nothing like that. And then before we even get to the wiring stage, we send you out paperwork, and the paperwork goes out by like a DocuSign. And it has a whole pamphlet of legal paperwork because it has to go through the SEC. So you can review it, you can sign it, you can have anybody else review it. You've got time to do that. It's not like a same day kind of thing. And once that's completed, you wire and your work is completely done. Gotcha. And then what we do is we send you a monthly update on the property, which is usually about a 5-minute read, probably aching up or down, whatever it is. And then at the end of the year, or the beginning, let's say March, April of every year, we're going to send you a K1 for the prior year, which is a partnership tax document. And you review that and you forward it to your accountant. So pretty much if the deal is going fine, like I'm in a lot of passive investments for real estate. And typically I would say I probably spent an hour per year on every investment after I've made the investment, right? So I'll do my due diligence on it. I'll review what I want to review. And then after I make the investment decision, then what I'm doing is I'm reviewing monthly statements. If I have questions, I'll respond to the email. If I don't, then I will just get that tax statement and send it to my accountant.
Gotcha. Okay. And HarborsidePartners.com is where people can go to sign up for these things that you're talking about if they're interested.
Yeah, that's fine. And you don't have to, you can sign up. We have a free book on passive investing. So you can if you sign up for anything on a thing, you're going to get our first level deals. There's 2 sets of deals that we send out, and not to get this completely complicated for everyone, but one part of our deals, when you log in, when you sign up for our newsletter or for our passive investing guide, it's what we call the accredited deals. And these are deals that we're able to advertise. If I have a deal right now and you were okay with it, I could pitch it right now and there wouldn't be an issue. Right. I could put a billboard up, and it's just an accredited. What an accredited investor means is that you have $1 million in net worth, not counting your home, right, or you make $300,000 with your spouse, or you make $200,000 per year as a single person. And if you check those boxes, you are an accredited investor. If you don't, then you're non-accredited. And we have deals, about half, I would say 1/3 to half of our deals are non-accredited. So if you don't hit the accredited bucket, but you want to learn more, but the key though is that you can only get the non-accredited deals. And you have to speak with one of us first on our team and with the beginning, because quote unquote from the SEC is we need to have a substantive relationship. So that's something that I have to, or one of the partners has to know kind of your personal financial situation, and we vet it for ourselves. I'm not going to take someone's last
Oh,
$50,000
sure.
or $50,000 that they need
Mhm.
for their kids' school in 2 years
Right.
or anything like that. So that's our decision. There's no rules per se, but it's something just for us how we do it.
Mhm.
And we want to make sure that you understand and you're sophisticated enough to understand the risks involved with investing, which anybody listening to the show is, but that's
Yeah.
just how it works.
Right. So let's take somebody like me. All I've ever done is single family, and I listen to this podcast, and it interests me in some level. And I call you up and I say, "Hey, Charles, I want to get in on one of these multifamilies that you're doing. What's the minimum entry fee into something like that? How much money am I going to need to do something with you?"
So typically it's $50,000 the minimum
Mhm.
investment.
Right.
When we used to do smaller deals, we used to go smaller than that. But now with larger deals we're doing and kind of 100+ unit deals, we put the minimum at 50,000, which is pretty normal.
Right.
Some larger syndicators will do 75 or 100. We do
Mhm.
50,000, and it's compared to going out and buying a multifamily property yourself, which might be $500,000, where you have to
Mhm.
put up 150 just for the down payment plus all the
Right.
work plus the reserve. I mean, you might
Mhm.
be well over 200. So for a fraction of what it would cost to normally buy a multifamily property, you're able to expose your portfolio to it. And a lot of people, this is all over the internet, all this stuff, and it sounds a lot sexier than it really is. But self-managing property for 6 years, I know exactly how it works. And I've gotten
Mhm.
calls on Christmas Eve to flush toilets and to do more
Right.
of the toilets and everything like that. So if you don't have the time and
Mhm.
you are in any type of business where when you find out what you're actually making hourly and you're making more than $25 or $35 an hour,
Mhm.
passive investing is probably a better route for you
Right.
unless you have a property manager and you want to take on the role of what we call asset management, which is really managing your property manager.
Mhm.
Because even when I had property managers for my own properties, and when I do now, it still takes work. I still have to make the high level decisions. I still am reviewing, I'm still getting on calls with our property managers. When we have these deals, we have a call every week with our property manager on these larger properties, and we're getting weekly PDFs that come usually on like Monday. And it tells us exactly what the leasing was, how many units that are being turned now. There's a lot of stuff going on, even if you're not in the property in the day to day.
Sure. And this is totally passive. In other words, if you send me out a deal that you've got and I say, "Hey, I want in with this," and it's 100 grand or whatever it may be, I never get a call. I never hear anything. I just get a check every quarter and then a distribution, I suppose, the payoff when you guys sell the complex.
Yeah, just to ease the numbers, because I mean, we're usually if we held the property, say, for 4 or 5 years, right?
Mhm.
Um, you're going to be you'll get about 40% of your return
Mhm.
uh, over those hold period, okay,
Right.
in the form of the distribution. The majority of it, 60%, will usually come on the sale.
Right.
And that's just gives you an idea. So you're getting some upfront capital with it, and the distributions will vary. This is not an annuity.
Mhm.
If we go through something like we've just gone through, we paused some of our distributions in 2020 when we had no idea in February and March what the heck
Oh
was
yeah.
happening.
Right.
And we restarted them once we had an idea what was happening.
Mhm.
But these are, it's you're investing into a business. And just like you with your regular properties, if you owned a duplex yourself or you owned a single family house yourself, I mean, you're not going to spend every dollar that comes in there. You're not going to use
Right.
every dollar of
Mhm.
profit that comes in there. And the same thing with us. We have to
Right.
keep a reserve, and we are distributing actual cash flow from the property that we're making. And while still, I mean, because we're going into these properties and we're taking something that's already making money, and we're
Mhm.
going to disrupt it a little bit because
Right.
we might go into a property that has 96% occupied property,
Mhm.
and we might bring that down to 89 or 90% occupied so that we can do renovations on these units and re-rent them. And where we are now in the market cycle, that occupancy will probably be higher because we'll probably be renovating less units, and just because we don't know where we stand with everything happening.
Right. Right.
If we are in a 2019, 2021 type environment, we're going to be rapidly renovating apartments to get the
Right.
value as high as possible. So it
Yeah.
all just depends on if the whole goal is, that's why we say 5 to 7 years, even though we might sell it in 3.
Mhm.
It just depends on where we are. And we want to make sure that everybody's on the same page going in, because we're going to be partners for that many years.
Right. Sure. And I don't want to misspeak at all, but did I hear you say earlier that historically your target is mid to upper teens as far as an overall return.
Yeah, if something pencils and it needs to be in the teens gross.
Hmm. Hmm.
And when I say gross is because we do a split with the investors. It's usually an
Right.
80-20
Hmm.
with us, or with the investors taking 80% and with us taking 20%.
Right.
And then, not to make this any more difficult, but typically what we have is we have what's called a preferred return of about 8%. So what that means is that it's 7 or 8%, which means that, say it's 7%, the investors get the first 7% of return. And then
Hmm.
above that 7%, we're going to split that 80-20.
Gotcha.
Okay.
Okay.
So for us to make sense, when I say gross and net returns, the gross returns are obviously going to be a little higher because we want to make sure that the net returns out to the investors are mid-teens. Because if it's going less than that, I mean, there's a lot of, if people are listening to the show and they're into sub two and they're into flipping houses or wholesaling and all these everything, they're real estate professionals. So this is a whole another level because of the tax benefits for real estate professionals. Myself being a real estate professional, you can really defer, and anybody that's owned rental property of any time, they know about all of the depreciation, everything goes
Sure.
with it. So that's one more thing. But what we're just saying is, so that's all and above, but really we need to have that kind of mid-teens of what we are saying, or it doesn't make sense for the risk that we're going to take. And I wouldn't consider these very high risk. The majority of my portfolios into multifamily syndications, but it's also something that, like anything else, I mean, diversifying, you have to know exactly what you're investing into. And we have a lot of investors that invest with us that are also active investors on smaller
Hmm.
properties. So
Sure.
it's not unlikely to have people that own 2 single family houses and a duplex, and then they invest into it to give them some diversification, not just on markets, but also on the size of properties.
Hmm.
Because the more units you have, anybody knows that's ever rented single family houses, the more units you have, the less volatile it is, because you have more
Hmm.
people, more income streams paying rent. And we're just taking that on kind of steroids from the beginning.
Right. Right. Guys, we're doing a crash course here today on syndication. But Charles also does a podcast where he talks about this, probably in more logical chunks where it makes more sense. So you can check that out at Global Investors Podcast. And I'm sure he's everywhere, Apple and Google and Stitcher and everywhere else. So you guys go do a search and get that. So what are some of the biggest mistakes that you see real estate investors making?
So what I'll see for new investors, or with new investors, especially on their first time into a single family property that they're doing for rental or
Mhm.
on small multifamilies, is not accounting for all the real expenses.
Right.
Okay. And thinking, there's, my mortgage is 1,200. The person's paying me 1,800. I'm going to make 600 times 12. You're definitely not. Um, you're laughing because obviously you've seen this before, and everybody's done this before in their first deal. They didn't know, you
Right.
know what I mean?
Oh
But
yeah.
it's something that you just have to put all your expenses,
Mhm.
and the less units you have, the higher vacancy you're going to have.
Right.
And when we're saying even small multifamilies will pencil out 10% vacancy for the year. When I'm saying smaller, 5 to 10 unit properties, we'll put that. And then as you get larger properties, when we're doing it, we'll usually put 5%. And after it's stabilized, maybe 4% vacancy. And it's still, you'll have people that say 5% vacancy because they found that online somewhere on a single family house. And that's not true. I mean, you're not going to have 1 month off of 2 years. You're not, you know what I mean? Kind of how it works. It's
Right.
not. And then also the make ready expenses and everything goes with it. So not having a reserve fund. And I
Mhm.
always tell investors, if you want to minimize risk when you're getting into multifamily, it's have long-term debt. You know what I mean? So
Right.
you can get long-term debt. It's much harder when you're going 5+ units. You can get like 5 or 10 years, but you can get 30-year on your 1 to 4 unit rentals.
Mhm.
That's huge. Have a reserve fund of 6 months of your mortgage payments, and have all the money that you want to put into the property, or you need to put into the property, upfront when you're buying the property. So
Right.
you can get in there. You don't want to be trying to take money from rent to try to replace the roof. It's just not going to
Right.
happen. It's going to be a
Yeah.
mess. So have all that money up front, the long-term debt, and and also know that when you're buying better properties, buy better areas. You might see something that looks
Mhm.
great, and brokers are fantastic at making a crappy property look very, very profitable.
Oh, for
So
sure.
it's just you'll see these huge returns, and you're like, and you don't want to be renting there, and you don't want to collect rent there, and you don't want
Mhm.
anything to do there,
Right.
because main thing, you're not going to find property managers that will ever take those properties,
Mhm.
and then also you're just going to have to sell that property to another buyer like yourself.
Mhm.
Whereas when you're dealing with better properties in better areas, you're going to be able to have more liquidity because it's going to be easier to sell that property in different markets.
Right.
And you're going to get a mix of both appreciation and cash flow. Everyone loves cash flow. I mean, we're all real estate
Mhm.
investors. We love cash flow, but the appreciation is great as well. And that's really so you can capture that when you sell it down the road.
You know, I've got so many investor friends that, and a bunch of them love mobile homes and they love low end rent properties. And man, these numbers are incredible. I said, I know they are, but there's something for me called the hassle factor.
Yeah.
Okay. When you're dealing with low end mobile homes and mobile home parks, and then really, really D level rental properties, I'm sorry, but I just, the numbers are incredible. You can buy that house for 10 grand, but my goodness, that's tough for me. Now I'm assuming you guys do these syndication deals all over the country. How do you decide what deal and what market to do this in?
Oh, that's a great question. So I'm based in South Florida. I'm based in North Palm Beach, Florida. And so we focus on 3 states in particular. And what we have is we work with 4 different partners that are on the ground in those areas. So really, our main areas are Florida. I'm just saying general states. Our main
Mhm.
states are Florida, Georgia, Texas. Within
Right.
those, we love Dallas, Fort Worth. Our last property we purchased was in Dallas. We love Greater Atlanta, the whole MSA. And then we love in Florida, the whole I-4 corridor, which we call it's like Jacksonville all the way to Tampa.
Mhm.
And so these are the areas that we've kind of pinpointed that we really like. And then we have people that are on the ground there, because when you're dealing with this, I want to have someone that is on the ground in one of these areas. We want to have an operating partner that's boots on the ground. If it's closer to where we are or to where someone from my team is, then we will be one of the people with boots on the ground. But in most situations, what we'll do is we are assisting with raising money on the deal. And we're also assisting with what we call the asset management. So it's getting on the calls with the property manager and keeping, we can do that from anywhere. If it's a Dallas property, we can do it from Florida. It's no problem. And then doing a lot of communication to our investors, and then also making decisions with our partner that's on the ground there, how we're going to stagger leases and do renovations and alleviate problems that show up all the time.
Right. Okay. That sounds good. All right. So tell me this now. If the average investor, just like me, maybe that's doing single families or small multi units, what is the best way for somebody like me to get started? Let's just say that I'm intrigued by the podcast today and I want to know more. Of course, I can go to your website and learn more. That's harborsidepartners.com. But what's the best way for me to get started in syndication?
So, well, with syndication, if you're going to start, if your whole main goal is to get the syndication and you haven't purchased multifamily before, purchase multifamily yourself. If you
Mhm.
already are doing deals, you have your sub 2 deals, you have other deals you're working on, buy something in your area and kind of stay with it and
Mhm.
stay within. When I bought my properties initially, I kept them all within about 4/10 a half mile of each other. Okay, it was very close. It was very easy for management. And that's key. I mean, it's very
Mhm.
difficult for you to drive 25 minutes to one duplex and over here to another one and stuff like
Yeah.
that. If you keep everything close with what you're already working with, right? So if you're flipping houses in an area, if you own some properties in an area, if you're doing sub 2 deals in some areas, try to find properties there. It'll make your management a lot easier. And then at some point in the future, you're going to want to bring on a third party manager or hire a handyman, whatever it is, to assist you with the management portion of it. It's going to be much easier for them because they're going to say, wait, so I got to do these units and then I need someone to drive 40 minutes away to get this other one. Like we can't do that. You know what I mean?
Mhm.
But if you can keep everything close, it makes the management so much easier. And that starts the kind of the scales economy right there. Right.
Mhm.
And that's what I would do. Number one. And number two is, we talked about before, long-term debt, having reserves. That's one thing I would also kind of focus on. And when you're looking at these properties and when you're underwriting them, make sure that you're buying properties that are easily rentable in the area, right? You can put ads out on all types of rental sites. So if you're buying a property, I hear this all the time when people ask me, they're like, well, it's got like a weird configuration. There's a 2-bedroom, then there's a studio, then there's this. I don't know if I can rent this or that. Every area is a little different. I found with smaller multifamilies in the area that I was invested into in central Connecticut, if I had 3 bedrooms in 3-family houses, people would stay for years, like many years. And that is where you make your money in multifamily, is keeping tenants preferably 24 plus months, right? So re-signing once, re-signing twice with you. And once you do that, you're cutting down your vacancy. And you don't have to go in there and repaint and re-clean their apartment throughout every year, right? And lose a month of rent if your team's good. If not, you might lose multiple months of rent. But so the main thing is you can put ads onto any of these free or something that's $10 a week or something to advertise a property and see what kind of calls you get at the price point you're trying to rent it for. You know what I mean? Because everything's very different. I've had properties that were not so good, and literally a block and a half away, I'd have a property that I had tenants there for 10 plus years. So, and paying never had an issue, nothing like that. So it's, everything is very local, as everybody knows in real estate, but just make sure that when you're there, you're looking at these properties and, that if people are already there living, it gives you a pretty good basis of what's happening with the rent is. If you're going into something that you might be getting from someone that's an absentee landlord and, it's not rented or it's poorly, managed or whatever it is, you don't know what the rents are. You can put an add-on for free, see who calls you. If you put something in for $1,200 online, no one calls you, but you put it in for $1,050 and it's all day long. Well, you just found your window there of where you probably can rent it.
Right. Okay. Yeah. You've mentioned something 2 or 3 times, and I'm going to ask you, where handyman, y'all use them a lot, I guess, in the apartment complexes. Where's the best place today to find a handyman?
We found them through referrals. Referrals were great, is great but not from other landlords. They want to keep them for themselves.
Right.
But from a handyman to another one. Right. And you would see it when I lived in apartments many years back, and I would always see this in larger apartment complexes. You would have one handyman that would just show up. Like you'd see one like pretty much all the time when you're walking through the hallways, right? Then you see another one that shows up once in a while, and they'd be like the ones that were brought in like part-time to like flip units. You know what I mean? And obviously there's some relationship between those people, where it's, it's a brother or cousin, whatever it is. So in that scenario, if you start with a good team, you can find people, and then you kind of can build off that with who you can bring on full time, because having the handyman in any type of multifamily is going to make it where it makes it the difference between, knocking your head against the wall when someone calls you, or having someone where you can step away for a week or so without any type of issue, because you can trust your keys to someone and then they can go in there and handle stuff. And that was one of the things that makes a difference. And that's why getting into the syndication model, because you can get better handyman because they're really in there full time, right? It's difficult unless you have really good relationships with people to try to get a handyman into a small multifamily that you own that's like 3 units. And I would do this before. I'd keep a list of stuff that had to be fixed, and once a month I would bring them in on like a Friday afternoon. You know what I mean? And if I had a good relationship with them, no problem. You know what I mean? But if you just call someone up and try to start that relationship, they're not going to call you back, or that, you know what I mean? It's very difficult to find people that show up. And then it's another thing to find people that are reasonable, that are going to do the work right and correctly, that you can trust to show up. So I found referrals from other people that are doing it. And then also just a lot of these people don't get paid by landlords on time or correctly, or they get jerked around. So if you can provide an experience where you don't do that to them, they're going to call you back, and they're going to go out of their way for you. And, it's having them is pretty much the foundation to multifamily investing.
Okay, great tips. Okay, well, tell everybody about your podcast, Charles. What are you guys, if they tune into your podcast, what do you talk about over there? What will they learn?
So Global Investors Podcast is really about passive investing and active investing in U.S. real estate. And we have about the majority of our listeners are from the U.S., but we have about 1/3 of our listeners that are abroad, and because we raise a lot of money from international investors to invest into our deals here. But I do one interview-based podcast like this per week, and then I also do what I call Strategy Saturday on Saturday, which is a podcast by myself that goes 5 to 10 minutes. And it's talking about all different aspects of real estate investing. And we talk about anything from, it's a huge thing on multifamily. So a lot of the interviews are on multifamily. I have people on self-storage. I just interviewed someone on investing in wineries. Whatever is with real estate, we love talking about no matter what. And then we will, like in my Saturday episode, it's going through everything, where you'll find an episode that's talking about what I look for when I passively invest in the deal. Talks about what prepayment penalties are, something you guys don't know about in the residential space. So stuff like that, you can learn more about what these are, and kind of getting yourself set up to invest into larger deals, because learning multifamily is good, and it's a great way of buy a multifamily property yourself with 100% of your own money, or maybe one partner that's working with you. So it's like a joint venture. It's not a syndication. And then you can learn how it works. And that's going to make you, so when you stepped into the syndication realm, the syndication shoes, you know exactly how the property works already. And that's going to build a lot of credibility for your investors, but also a lot of confidence for yourself when taking down larger deals.
Okay, sounds great. Okay, and if they go sign up over at harborsidepartners.com, they'll learn a lot more about syndication, and they can actually sign up and get on your list to be an investor. Is that right?
Yeah, you can sign up as an investor on our website, no problem. Everything's on harborsidepartners.com, the podcast, YouTube channel, the whole 9 yards. We also have a passive investing guide there. If you sign up for the passive investing guide, and we also have a weekly newsletter we put out. I put it on Wednesdays, and it's kind of like a bullet point list of a lot of links and different facts of what's going on in the economy right now, and a lot of links that I've handpicked myself that one of our assistants puts together and puts out there. And it really gives you a rundown of there's a lot of single family stuff in there too. So because multifamily, when you're renting in B and A class properties, you have a lot of people that might be wanting to buy a house. So it's very where you're keeping your tenants and what's going on with tenants that might be buying houses or not buying houses, as we see now. It tells you exactly how strong the rental market's going to be. So we have a lot of stuff on real estate there, a lot of information, and you can come get educated, and everything's free.
Oh, awesome. Well, that's great information, Charles. I'll tell you, I can't believe you've done it, but you've actually got me interested in syndication. I thought I would be a single family person forever, but it does sound interesting, especially the passive part. Okay. You're just going to give me a good return, and I'm not going to have to do anything. Everybody that knows me knows I am anti-landlord. The thought of multifamily just would keep me awake at night. But if it's totally passive, man, I'm all over that. So that's great. Listen, we really appreciate you coming on today and sharing that with us. That was tremendous.
Thanks so much for having me on today, William.
Okay, awesome. Okay, guys, that is it for this episode of the Sub2Deals Show. We really enjoyed talking about syndication today. So, guys, listen to Charles's podcast at Global Investors Podcast. It sounds really great. And if you're interested in syndication and being an investor or learning more about it, go check out harborsidepartners.com. So, guys, until next time, get out there, talk to some sellers, and buy some houses.